This next session is going to be one where we're going to engage in some interesting discussion. And once again, I'd urge you, if you have any questions at any point during the course of the discussion, just send them up here, because we'd very much like to engage you in this process. If my colleagues, panelists, would like to come up on the stage here, that'd be great. We have three panelists helping me today. And basically what we're going to do is I'm going to give them a very, very, very short introduction, and then give them 5 minutes or less each to tell us a little bit about what their companies are all about and what they specifically do. In terms of the very brief introduction, I'm going to say first here on my left, your right, we have Dana McGinnis, who's principal and founder of Mission Advisors. He tells me he's been in the industry for a while. When he said Roten Mosley, I was going, wow, I haven't heard of that name for a while. So he really has been. Next to him in the middle, we have Tim Kissling, who's managing director with City Energy Group. And he's led some very, very noteworthy transactions that in M&A, which I think he'll share some of it with us. And then at the end, we have Sam Pitts, managing director with NCAP Flatrock MidStream. He also happens to be ex-Citibank, but now obviously working with NCAP with a record of a lot of transactions, and he probably should be your best friend if you're looking for some private equity. So with that, I'm going to sit down, and I'm going to let each of these panelists talk a little bit about their companies, what they're about, and what their specific area of expertise is. Why don't you just keep sitting? Yeah. There we go.
So we go now?
Yep.
Hello, I'm Dana McGinnis of Mission Advisors in San Antonio. I want to thank you, Chris, and thank you, Hart Energy, and their sponsors. I've been to a number of these forums over the past few years, and they're always excellent, so thank you for that. Mission Advisors is a private company that runs a private partnership and takes managed accounts. We mostly invest on the public sector side, although our partnership is private. We started our energy fund in 2009, 2010 in the face of compelling evidence that with $100 oil and the new technologies and the new shales, that production was going to dramatically improve in America. We decided to focus our strategy on the takeaway, on the pipelines and processing companies, instead of having direct oil or gas price exposure. That worked out well for us for 4 or 5 years. We decided, well, it was pretty obvious that prices were going to head down, and they did in late 2014. At that point, we pretty much got out of our exposure, and we rotated into some of the refining markets, which we thought were not going to have as much risk as some of the other pipelines, which we thought were going to potentially lose volume. So that brings us to today, where we've had a couple of years of lower prices, and it looks like we've always looked for growth. Where's the growth in volume is going to come without exposure to price? Now, price does have a significant factor over the long term on the abilities of people to make money and put those volumes into the pipelines. But now it looks like the only growth is in the Permian Basin. And so we think the Permian Basin, of course, it's no news to people here, drives the energy world, drives the pricing mechanism for energy, and also has a large degree of influence on geopolitical factors. If you think about the OPEC type countries and the countries that are dependent upon oil, it's not so much the cost of oil, it's the budgets that they have. So this drives it as much as it drives the cost in America. If you think about the the Saudis that used to need $100 to break even on their budget. And you remember that they subsidize lots of things over there, pay their citizens taxes. They've cut their budget by 30%, so that theoretically would reduce their cost break even to $70. They increased production by 10%, so theoretically now you're at 60. We don't see 60 for quite some time. So this puts a real pressure on everybody and brings the focus back to the Permian Basin. So we're focused back on the Permian Basin and people that have leverage there, that can increase volumes, and at the current price. We're not expecting the price to go anywhere. We hope it does, but our base case is around where it is, maybe even a little lower. So, changes.
Yeah, go ahead.
So basically our client base is high net worth families, individuals, institutional clients. As I said, we manage private partnerships and separate accounts. And we're currently focused in the Permian Basin. And I think within a month or two, we'll have another private partnership focused on royalty interests, focused in the Permian Basin. That's Mission Advisor San Antonio. Okay. Thank you.
Can you pass the...
Thanks, Dana. Hi, Tim Kissling, Managing Director with Cities Energy Group. I focus 100% of my time on the midstream space. Appreciate the invitation to be here, Chris. Just a little bit of background on the City Global Energy Group. You go back to the summer of 2010, Steve Trauber was running UBS's Global Energy Group. He met with Ray McGuire and Mike Corbett, the head of investment banking and the CEO of Citi, with a pitch saying, look, you guys are very good internationally. We're very good domestically. We're each a top 5 firm in global energy, but we're kind of on the back end of that. We're 4 or 5 or 5 and 4, depending on how you want to kind of cut the different league tables. The pitch was you combine the two platforms, you combine the strengths of the two platforms, and you can really create the global leader in energy investment banking. He made that pitch. A month later, September 2010, he pulls the Art Modell, and 30 people resigned from UBS that day. 90 days later, they appear on the Citi employee books. And really, that was the formation of the global energy franchise that we, anchor us today. The bottom of the page really just is the league table data that validates what Steve's vision was. That if you were to put together the UBS and the Citi teams, is that you are going to create a global leader in energy. And the league table there talks about M&A, equities, and debt. The other thing that the merger with Citi gave us that we didn't have at UBS were kind of twofold. One is a commodity desk, and the other is an A&D shop. We have the largest A&D shop on Wall Street, 30 different professionals. They make the joke in every meeting that if they had a landman, they could be an E&P company. And they've been instrumental in terms of how we've driven business, because the business has changed. And how we execute our business on the midstream side has changed, become much more technical over the last 2 years than it ever was, prior to that. Sorry for the small font there, but this is a slide that myself and my 2 partners, we're a 3-person midstream team, at least at the managing director level. Michael Jameson runs the group. Michael Casey and I are his partners. What the small font is showing you is the 40 largest deals done in the midstream space since we joined up with the Citi franchise. Kind of dates back to kind of 2011, 2012 timeframe. What you see is that Citi logo. That's the deals that we were a part of, and we're attached to the advisor there. And if you did the math, it's we've been part of 30 of the 40 largest midstream deals that have been done in the last 5 years. So we've been a core part of the consolidation of the space. And it's funny, we get often asked, when is the MLP space finally going to consolidate? It's pictures like that say, look, we're not in the first or the second inning here. We're much later on the consolidation game than people kind of think. It's much more in the sixth or seventh inning. The only other part I'll just make observations of is three different transactions or three different stories. We sold the Reliance Pioneer joint venture in the Eagle Ford to Enterprise. Prior to that transaction, we advised Enterprise on its acquisition of oil tanking. 2016, we sold Tall Oak to EnLink. 2 years prior to that, we advised Crosstex around the formation of EnLink. This just past January, we sold Outrigger to Targa. 18 months prior to that, we advised Targa, the MLP, on its consolidated roll-up into the C Corp entity. All that talks about is it's important to have the A&D team, but at the end of the day, when you look at M&A, what drives M&A is the relationships. It's the trust that's on both the buy side and the sell side, and our access, Michael and my access to the C-suite, to the board of directors, to principals like Sam, and to the management teams is core and important part of how we get deals done. And happy to be a part of the franchise.
Okay. Good morning, everyone. Thank you all for the invitation to be here. It's a privilege to be in front of all of you with my fellow panelists here and to have an opportunity to share a little bit about EnCap Flat Rock. We focus exclusively on providing venture capital to the midstream sector. We were established a little over 9 years ago, and since that time we've raised 3 institutional funds and manage a little over $6.5 billion. Our investment staff blends financial and operational / engineering experience, and we enjoy a great collaboration with our partners at EnCap, who have raised over $25 billion in upstream dedicated venture capital. So we think the comprehensive, I suppose, suite of experience is an asset to the teams that we back. And talking about our business model, it's straightforward. We hope to be the preferred partner and capital provider to the best startup midstream management teams in the industry. And I get to stand up here and be the face of their accomplishments, but the fact of the matter is they are the real stars of our portfolio. And you'll get to hear from one of our very best later in the day when Mike Latcham from Lucid Energy gets up here and speaks. So I'd encourage everyone. He's much more capable of giving a significantly more compelling narrative than I am. So I'd encourage all of you to stick around and hear what he has to say. We take a very producer-centric view towards midstream investing, and that not only refers to understanding the upstream resource, it also encompasses a service mindset that's very focused on the producer. And it's been said many times here today, that's because this is a relationship business. Not only between us and our portfolio companies, between them and their customers, and that's really, at the end of the day, what we think drives value.
Great. Well, thank you. Again, just to reiterate, if people have questions, send them up. In the meantime, I'm going to start our panel discussion here. Nothing like asking people about commodity prices the day before an OPEC meeting. I know we all like to say that midstream's much less sensitive to oil prices, but obviously it's a big factor. How do you guys try and factor in, a commodity outlook in terms of midstream? Let me start with you, Tim, just because
Sure.
I know you've got a great commodity team at Citi that you mentioned.
Yeah, Ed Morse is one of the leading global commodity strategists, and I'm happy to tell you all in the meeting, he is one of the more bullish analysts out there. His view on tomorrow's meeting at the OPEC is that it's going to follow kind of what Russia and Saudi Arabia has hinted at. that'll likely be a 9-month extension. He thinks that if that's how it plays out, that we could be looking at Brent oil in the 60s by June. He thinks it's a little bit of a rocky road from June to the end of the year, but he thinks that we exit 2017 at and around $60, and we stay there throughout kind of 2018. He thinks what'll end up happening in 2018 is if you get the $60 stabilized oil price, that we're going to drill here. He forecasts 2019 to be, in the low 50s in terms of an average, with a dip into the 40s at some point during 2019. And then from a 2020 on perspective, he's 65 and higher. The biggest difference between he and a lot of his competitors is he's relatively bearish on Iran, Iraq, and Kuwait. Collectively, he's got them about 3 million barrels underweight versus their stated goals in terms of what their production output's going to be 2020. He thinks the biggest risk to kind of his forecast are those three being better producers than he's forecasting, and his swings are Libya and Nigeria. They're kind of the wild cards in terms of how he kind of sees things kind of playing out.
Sam, do you even try to put a commodity outlook out there, or do you use the strip, or what do you do on the midstream side?
No, I mean, we don't call commodity peaks and troughs or base our investment decisions on a macro view of a directional move in commodity prices. I mean, I think what we try and do in collaboration with our teams is identify areas with midstream needs and where we can be disciplined about deploying capital in risk-adjusted ways that generate our returns. So it's certainly subject to the influences of positive or negative moves in commodity prices, but we try and mitigate that through a conservative approach to capital structure and a deliberate pacing of putting money to work through the investments.
Dana, anything, you seem to be on the same page a little bit with the Citigroup in the sense that you're saying sort of more of a range-bound sort of outlook. You think that's going to happen for the next several years?
Well, from our investment point of view, we try not to be dependent upon the price of oil. We look for the volume, and whether you can make money on the volume increases. And the only place we really see that again is the Permian Basin. But on the commodity issue, we do talk about this almost every day. So you have two factors working. You have depletion on one side. If you're not drilling more wells, even in your good fields, your production is going to go down through natural depletion. And if you look around all the fields in America, production is down year over year, except in the Permian. So the information in America is very good on that. The information is very poor in the rest of the world. So you don't know really what it is, but you have to believe that the depletion side is at work there. If you look at what's happened in Venezuela, Nigeria, they don't really have the money to maintain their production unless prices are higher. So you have various pressures. I do think the evidence points to more production than people predict out of the Permian. And there's, in the original OPEC agreement, everybody ran their production up and then they made an agreement. So there's a lot of oil around. It's being drawn down, but the information is not reliable. And if production comes up in the Permian more than the consensus, which is our view, then it's going to be a while before you work this off, even with the natural factors involved. So while 3 or 4 years from now, yeah, I can certainly see higher prices, but in the next couple of years, it's hard for us to get there. Mm-hmm. And we'll see what happens tomorrow. It's in everybody's best interest in OPEC to cut. I mean, to leave the cuts in place because they don't want to see the prices go down 20%. Mm-hmm. to save a 3% increase in volume. So,
Tim, let's talk about MLPs, because last night I know we were talking a little bit at dinner, and we were talking about how there was a time when you had the ability to do overnight deals. I sort of get the impression that MLPs are more in favor, in part because, if we are in a more range-bound, environment, volume growth, obviously, as you pointed out, is important. And so what do you see in terms of the appetite for MLPs institutionally and retail? Dana, maybe you can add a little bit on that too, but how long does it take for, that comeback of the midstream MLP to really be front and center?
Yeah, look, every day that we move past kind of February of 2016, the MLP equity market is getting healthier. That said, we're 15 months through kind of the low point in the cycle, and we haven't really seen that retail bid come back into the MLP equity market. Even the institutional investors that are the core investors and drive kind of the MLP equity sector, they get their funds from the retail investor. And while inflows have been positive for the most part over the last 15 months, they're significantly less than the outflows that ran from the market in kind of the 15 and 16 timeframe. And really what you've seen and how it's kind of manifested itself is when we looked at the top 40 largest M&A deals done in the space since 2012, the only private equity acquisition done in that time frame was done last month. And it was Blackstone taking advantage of the fact that there's dislocation in the equity market. If you're going to write a $2 billion check, even your biggest MLPs struggle a little bit in terms of getting up to that number. And they made the opportunistic play to, this is the first time we're going to play big in the midstream space. And it was because they just thought that the depth of competition for an asset that size was the lowest they've seen in probably a decade. The other corollary to that is, you've seen the increase in SPACs. We've had a number of SPACs, including a midstream dedicated SPAC being run by Kayne Anderson. Kayne Anderson is the investor in the MLP space. They saw the disconnect between, the ability to raise equity in a timely, cost-effective manner. And what did Kevin McCarthy go out and do? He got a blind pool of cash raised of $400 million to, again, take advantage of that dislocation. So it's getting healthier. We just as professionals would have looked back a year ago and thought we'd be back in a much better place than we are today. But we're just not quite there yet, Chris.
Mm-hmm. Any sense in terms of MLP appetite amongst high net worth people? Just is it coming back?
Well, it's I'd say it's lukewarm at best, and I think it's because although there's a lot of capital available for specific projects, for things that are demonstrably growing, like stuff in the Permian Basin, like a line into Mexico or something that has contracts and they know where the volume's coming. But in the general MLP industry, if you're a diversified company and you're growing in the Permian and you're shrinking other places, it's hard to show year-over-year growth. And since the MLPs pay out all their cash for the most part, it's difficult to show real growth unless you're focused on some growth area. Mm-hmm. So that's why the demand is okay, but I can't say it's robust.
Okay. Sam, let me go to you. This is the big picture discussion we've had all morning. Mm-hmm. When I drew up, this question about a week ago, I felt comfortable in saying that crude production was running in the Permian around about 2.2 million barrels a day. I've already seen one report saying it's now up to 2.4, and I'm going, wow, that's 200,000 barrels a day increase in 10 days. That's amazing. But how do you see the interplay between production and takeaway? Do the various projected takeaway projects that we've heard about happen in time, and how do you see that?
Well, I don't want to handicap anyone's individual project, but these are substantial investments. Mm-hmm. And as you look forward and project when production is going to surpass 3 million barrels a day and when that's going to create an issue, I don't know exactly when that happens, but the cheapest way to add capacity is to augment the throughput on an existing line. And I think you've seen just about every line out of the basin announce a project along those lines. Now, a new line is going to require a producer to come forward, a producer or producers to come forward and sign up for firm transport. The dollars are just too great to spec build that kind of line. So it's a bit of a chicken and egg, and when, you know, if I'm a producer and I look out there, it looks as though there's a lot of incremental capacity coming online, and so my desire to assume what could be a pretty significant liability on my balance sheet in the form of that firm transport, I may be waiting a little bit to see how everything plays out. You know, additional consideration, I think one that Ismail addressed a little bit in his lines, is that it's equally important, kind of the optimization of the destination point. And not all these barrels are the same, and that has meaningful implications on where they should go. And you don't necessarily see that priced in the wellhead transactions right now, but that could change. So a differentiator amongst the new builds will be system design and route that best marries the type of barrel being aggregated with the market in search of that kind of barrel.
Okay. I'm going to let other people jump in, but I'm going to also just throw out another question as we're thinking about it, and that is that, you know, I was listening to one of the quarterly conference calls by a very prominent Permian-based producer, and they were almost flippant in the sense that they were saying there's so much private equity sitting on the sidelines that's, you know, available. Obviously, the $2 billion transaction that you just highlighted, Tim, and you know, that's one example, but does any of you guys have any idea how much private equity is really on the sidelines, and you know, how much, you know, is available?
I'll let you go first.
A lot. But I don't think it's just private equity, right? I mean, I think just about anybody with a checkbook and an occupation that can loosely be described as midstream oriented is looking at the Permian. And with good reason. I mean, we've sold some midstream businesses in the Permian. We still own some midstream businesses in the Permian, and we're continuing to look for ways to invest. Now, the reference in your question was specific to takeaway, and I guess it goes to the producer mindset right now that the problem will fix itself. Mm-hmm. And I think the presence of private equity or the absence of private equity doesn't change the way that takeaway capacity is going to evolve in this basin. We're going to look at it just like a midstream company would. I presume our competitors are going to look at it just like a midstream company would, and we'll be prudent and disciplined about how we approach it. But there is a lot of capital out there. I don't want to put a number on it, but mm-hmm. It's pretty big.
But when he's referring to the large capex oriented project, let's call it the $1.5 billion to $2 billion kind of or organic kind of growth project, those are much better suited for Rob and Magellan than private equity, greenfield kind of builds. Those are the type of projects to bring the crude from the Permian to Corpus, Permian to Houston, Permian to Cushing. I mean, that's an enterprise, that's a Magellan, it's a big boy game.
Mm-hmm. So, and I'll just tack on a little bit. So you see who are the big operators in, say, the Delaware or even other parts of the Permian. I mean, you're looking at Anadarko, Exxon, Chevron, that they don't need private equity. And these things are going to get drilled and built with their own capital. So, I mean, there's a place certainly for a lot of private equity, but you're seeing a lot of big capital from these big producers going especially into the Delaware. Mm-hmm.
This morning we heard some pretty interesting greenfield stories, and in the past I've always thought that, you know, those overnight offerings that we used to see in the MLP space were often to do add-on type of things, but for greenfield type of opportunities in terms of midstream and in areas where, you know, there's no real existing infrastructure, and I'm trying to remember, but you know, the cry went out for anyone to help us do a JV, and there was no one there. How does it stand now in terms of where do any of you guys think that these greenfield opportunities may be turning into the type of opportunities that they need real money and need to be developed? Do you have any sort of thoughts on that, Sam?
Well, I think you know, like we said at the beginning of this, you know, panel, it's very much a relationship-driven business, and our greenfield opportunities are generally presented to our companies, be they through an NCAP affiliated upstream business or through a relationship in the industry. I would tell you that we do a ton of work with Anadarko, Exxon, Chevron, all of those big companies, because the guys that we are partnered with, teams that we're partnered with, have had relationships with them, and those teams or those companies recognize they're capable of executing, and in some cases have brought them into areas to build out greenfield systems for them. And you know, hopefully on the other end, like has happened in the past, are there to buy those systems once they get fully built out. You know, the next greenfield development that's taking place, I mean, I think, you know, the companies that we're partnered with would not be appreciative of me standing up at a MidStream conference and advertising, you know, where they're building out their next systems. But what we do see is with the rejuvenation or revival of the rig count, that it's getting a little bit more dispersed, and we've left a time where, even though there's still a heavy emphasis on the Permian and on the Scoop and Stack in Oklahoma, it's not exclusive to those areas. So we're seeing kind of the opportunity to deploy capital outside of just these two, you know, basins out here in West Texas is growing, but it's still getting the you know, the majority of the attention, and it's still looks to be the best economics in the country, if not the world.
Yeah, I think we benefited all today by hearing, you know, two of the greenfield success stories, both the Brazos team and the Sendero in the earlier panel. You know, we anticipate there to be a number of those types of opportunities, you know, going forward. You know, the land grab certainly isn't over in 2017. It certainly extends into 2018. You know, all of these plays are tending to prove out to be bigger and bigger as the drilling technology and the improvements of the wells can continue to kind of push on.
Let me switch over to gas, and let me broaden the question, because we've already had a lot of discussion on natural gas this morning. But can you just give us some broad thoughts in terms of what you think the opportunities are in natural gas? And not just, you know, limit yourself to the Permian, but also, you know, to look ahead. You know, the Haynesville, you know, people are doing some really remarkable things there with recompletions that have revitalized, you know, levels of productivity. And even in the Eagle Ford, you know, liquids prices are up, and so there's a little bit more drilling there. Where do you see the need for investments to be concentrated? Do you want to take a shot at it, Sam?
Sure. I think that you know, the upstream industry is a remarkably resilient and dynamic group of companies, and so, you know, the R&D work that has been done has been exclusively concentrated in the Permian over the past couple of years, and the Haynesville, as you just mentioned, is one of the first areas to see those kind of best practices kind of transported in or imported in rather, and you've seen the benefits of that. You know, there's still a decent amount of excess capacity in that area to absorb some growth back to where it was. But I think the bigger picture story of, you know, of taking what has been, you know, refined and certainly not perfected, because the upstream industry is so good at extracting hydrocarbons, but taking the kind of current spot market for best practices and moving them into other basins is creating a number of opportunities everywhere, and it's revitalizing, plays like the Haynesville that were kind of here and gone before you could blink an eye.
Anything to add on that, either of you?
No.
No. Let's I'll just try and run over a number of questions here because time's drawing down a little bit here. One quick question, Sam, is why don't you just give us a little discussion about what type of rate of return or IRR that you guys are looking for in terms of projects when people come to you, and also why don't you just broaden that out in terms of what your general expectations are in terms of management teams. I'm sure a lot of people want to hear what you're looking for, what are your key points?
Sure. So, by the way, I'll be here all afternoon, so please, if you have questions, please don't hesitate to reach out to me, or there are a couple other people wearing in-cap Flat Rock, badges around the room. I'd prefer not to address, specific numbers around returns in this forum. But I'd be happy to go into more detail in a private conversation. But I would tell you in terms of teams, what our typical team looks like when when they come to us, and there's no kind of one size fits all, but generally, speaking, it's a 4-person team at the outset with CEO, CFO, Chief Commercial Officer, and Chief Operations Officer, and that our typical arrangement is for a kind of multi-year overhead backing with a kind of a significant commitment of equity once a project goes into development. But really, like we said, this is like, and I know I sound like a broken record, this is a relationship-driven business. And, we like to spend a lot of time with our teams in advance of making a commitment, both so that they know us well and understand what they're getting into with us and vice versa. And the teams that are most successful or that have been most successful are the ones that bring customer relationships with them to a degree that customers want to do business with them, and will reach out to them and kind of initiate the dialogue around developing assets.
How about on the other end of the spectrum, instead of people starting up projects, how do you see consolidation, Tim? I know you've just done this massive transaction, without rigor, et cetera. What are your views in terms of potential consolidation? And I know some of it's sensitive, but do you see there an increase in M&A activity?
Absolutely. I mean, when you travel through boardroom to boardroom at the large cap MLPs, they're all focused in on what I'll call even the large cap consolidation. I think in terms of kind of the shot heard around the world, that was the Enbridge Spectrum merger that was announced in September, when you're pairing a world-class organization on the gas side with the world-class organization on the crude side to really build together a best-in-class midstream, global midstream type company. That's made everybody kind of take a look at the chessboard and understand that if different consolidation trends happen, what happens to them? Who is their preferred merger partner and why? What happens if that company goes away? What's your fallback? All those discussions are real live and happening across the boardrooms. In terms of the asset M&A transactions, like the Outrigger deal, the Navigator deal, the Alpha deal that we've seen, those are all sizable transactions as well. And we continue to expect to see a flurry of those deals happen throughout 2017 and 2018. So as you think about consolidation, we do expect a number of the large cap deals to get done. Our own personal view from the midstream group at Citi is, when you look at the MLP world in a 2020 basis, there is 6 or 7 very large cap MLPs. There's going to be the captive MLPs, the Shells, the Dominions, the PSXPs of the world, and then you're going to kind of have a lot of the stuff that's kind of left over. But it's all going to be about that. Those big 6 is going to be the mid-cap, large cap coming together over the next 5 years.
Chris, I think I'd just add to that. I mean, no matter what stage of the midstream kind of broadly defined sector you are in, you are pursuing a resource capture strategy. And what all of those assets that Tim just talked about, what every deal we've ever sold addresses is you're chasing throughput and you want exposure to as much resource in the best areas with the best economics that you can get to. And that's what's going to guarantee that, you know, you're going to preserve the cash flows on your system. And so whether you're in the Permian or whether you're in some of these other areas, to the extent you have built a franchise with kind of resource dedicated to it, that's a must-own asset. And so no matter what point in time you were in the past couple of years, you know, there was, and you've seen the capital markets willing to step up and provide capital to be in those kind of must-own, or to facilitate the acquisition of those must-own franchises.
Just one last question for all of you guys. Any sort of trends that you see coming up in terms of financing? Do you see, you know, converts, you know, coming back? I think there was, a year ago, there was some pretty big acquisitions with some convert financing. Do you see spin-offs of MLPs? I know we've had Oasis talk in terms of spinning off their midstream assets. Anything that you see there in terms of trends?
Well, I think it's twofold on the convertible preferred market. I think they were done in the past 18 months, one to help balance sheet support, and the second was to fund acquisitions. I think for the most part, the balance sheet repair is done in the space. But again, when you look at the ability to, you know, take on one of these large potential acquisitions in the Permian of the independent kind of management-led midstream teams that are still out there, you know, you're looking at purchase prices at $2 to $2.5 billion. I think that's a role where, you know, I'll call it the TPG-like capital. TPG helped EnLink buy Tall Oak a few years ago. I think those are the opportunities where you can see that preferred come back into the market, but it's not going to be to repair balance sheet anymore.